Risk management with derivatives involves using financial instruments to hedge against various types of risk, such as price movements and interest rate changes. This is essential for protecting portfolios, maintaining stability, and achieving financial goals. There are several types of derivatives used for risk management, including options, futures, forwards, and swaps. Options provide the right to buy or sell an asset. Futures and forwards obligate the purchase or sale of an asset at a future date, and swaps involve exchanging cash flows or financial instruments. Hedging with options includes strategies like the protective put, which involves buying a put option to protect against a decline in asset value, and the covered call, which involves selling a call option while holding the underlying asset to generate income. These strategies provide downside protection while allowing for upside potential. Let's implement a protective put strategy to protect the value of a stock investment. We identify the stock and its current price, select a put option with an appropriate strike price and expiration date, and calculate the cost and potential outcomes of the strategy. This example demonstrates how a protective put can limit losses. Hedging with futures involves using futures contracts to lock in prices and protect against price volatility. A long hedge involves buying futures contracts to protect against rising prices, while a short hedge involves selling futures contracts to protect against falling prices. Let's implement a short hedge with futures to protect against a decline in the value of a commodity. We identify the commodity and its current price, determine the number of futures contracts needed, and calculate the potential outcomes of the hedge. This example demonstrates how a short hedge can protect against price declines. Hedging with swaps includes interest rate swaps, where fixed interest payments are exchanged for floating rate payments to manage interest rate risk, and currency swaps, where principal and interest payments in different currencies are exchanged to manage exchange rate risk. Swaps provide flexibility in managing cash flows and exposures. Let's implement an interest rate swap to hedge against interest rate fluctuations. We identify the notional principal and fixed and floating rates, calculate the cash flows for both parties, and assess the impact of the swap on interest rate risk. This example demonstrates how an interest rate swap can manage interest rate exposures. Effective risk management strategies using derivatives involve diversification, dynamic hedging, stress testing, and risk monitoring. Diversification involves using a mix of different derivatives to hedge various risks. Dynamic hedging continuously adjusts hedge positions based on market conditions. Stress testing evaluates the performance of hedging strategies under extreme market scenarios, and risk monitoring involves regularly assessing the effectiveness of hedging strategies. Let's implement a dynamic hedging strategy for a stock portfolio. We monitor the portfolio and market conditions, adjust hedge positions based on changes in market conditions, and assess the performance of the dynamic hedge. This example demonstrates how to continuously manage risk using a dynamic hedging strategy. Derivatives used for risk management include options, futures, forwards, and swaps. Hedging strategies such as protective puts, covered calls, long and short hedges, and swaps help manage various risks. Effective risk management strategies involve diversification, dynamic hedging, stress testing, and risk monitoring. Practical implementation using Python allows for calculating and adjusting hedge positions to effectively manage risk.